silver's fundamental value at this moment is somewhere between 1,300 and 2,000. According to my calculations, you're looking at the true fundamental value of an ounce of gold at somewhere between $33,000 and $40,000 an ounce. So at 3,400, spot gold is a ridiculous bargain.
It means that Saudi Arabia would be an administrator and would be able to take hold of the silver underneath. What was really going on was that our government was openly rigging the silver prices. When a president says they are going to control the markets, that's a sign that silver is being used up in industry. Gold and silver, on the other hand, are good forms of money. Sound money is money that can't be inflated away by the government or central bank. I think it will happen. When it comes to silver, it is clearly a metal that is way too cheap by all measures. A lot of people are also pointing to $50 silver as the number. That would bring us back to the theoretical all-time highs from the past. But if we look back to 1980, $50 was equal to $196 today. Now let's go back to the year 2000. A lot of people say 1980 doesn't count. As it turned out, the Hunt brothers short squeeze did happen. The price of silver didn't rise naturally like that. Some people will say that's not true and that we should use the high from 2011 instead. Yes, but silver is still worth more than $100 even in that way. Do you believe that the price of silver will reach $10 an ounce soon? What do you think about that? I could, and I do think that that triple-digit price is fair. Now, one thing you said about the Hunt brothers collecting silver in the 1980s, it was clear that they wanted to leave the U.S. and make their own little country in Texas. The claim that silver is $50 hides the math. The 1980s high point is equal to about $200 today. Using standards that take inflation into account shows that silver has not done well for decades. Gold's rise from $35 in 1971 to over $2,000 today is behind. Analysts like Peter Bukvar say that the industrial demand for silver makes it more volatile, but it also means that when supply shrinks, there is asymmetric upside. Investors who are looking at the $49 spike in 2011 should remember, it happened when QE filled the market, but silver still went back down quickly. If triple-digit silver is possible, it has less to do with the past and more to do with how liquidity works today and how physical supply lines work. The next thing we'll hear is why government interference makes it hard for prices to be set, but that shouldn't be taken lightly or overlooked. What we were really dealing with was our government openly manipulating the silver markets. Everyone was told about it. Jesse, I have to say that I have often wondered when these things happen because they seem so crazy to me, like taking away people's gold and silver or a president saying they're going to influence the markets while they're still in office. I used to wonder how they got away with it and why someone spoke out and said, no, you can't do that. That's crazy. I think we're going through that right now. I can see it happening. Many people seem to be blind to what's going on. As a result, I do think the $50 mark is a good one for your point, which is that these markets are rigged. It's clear that they are being influenced. So anyone who really thinks that spot gold or spot silver prices will go up will be disappointed. And I always say spot because it's just a contract. When leaders say they are manipulating the market and no one is shocked, you know that price discovery is dead. It's not impossible that what happened with gold in 1933 or silver in the 1980s could happen again. Centralized power works best when people don't question it. Scholars like Lawrence Summers have written about how Gibson's paradox relates to interest rate policy and the banning of gold. Why would metals be different if the Fed is clearly meddling in bond markets? Spot contracts are like paper games and don't represent real flows of money. This gives small buyers the impression that the market is fair. Systemic rigging that never really stopped is hidden by blind trust in market prices. Next, we'll look at how LBMA data quietly backs up this difference between silver on paper and silver in real life. And when it comes to silver, the LBMA made a chart, and we all know that a lot of metal came into the US at the start of this year. And you can see the gold shops in the LBMA going down, then back up, and then down again. They are pretty much back to where they were before whatever came out of the LBMA. Actually, I'm more interested in what the BOE said, but let's stick with the LBMA for a moment because the same problem happened with silver when it was shipped over, but their stores are a lot lower than they were before the metal push into the US. What does that tell you? It says that silver is used up in industry, and just like the SLV Silver ETF, which is meant to be a basket of silver, they couldn't put it together. So back in, I don't know if it was 21 or 20, but they changed the brochure. SLV changed theirs. Prospectus. They didn't have to actually bring in a basket of silver. All they had to do was copy the spot silver market, which is what they were meant to do anyway. LBMA stocks are very different from one another. Gold stocks went back up, but silver stocks are still low. It's not an accident. Silver, on the other hand, is used in health, electronics, and solar panels. In other words, it rarely comes back once it leaves banks. In 2021, SLV even changed its prospectus to basically say that shortages could stop new shares from being made. This is a very unusual thing for an ETF to say. Investors who think that SLV is the same as real exposure don't care about this paper substitution risk. The BOE moves are also important. Small investors won't know if national vaults are quietly emptied. The real way to find prices is not in the spot ticker, but in falling stocks. Next, look at how the buying habits of central banks disprove the old myth that no one stores silver. That says a lot. That tells me a lot when you talk about silver. As for silver versus gold, one of its problems has always been that state banks don't buy it.
We've seen an interesting change. It's not as exciting as some people may be making it sound because it has to do with the SLV ETF you just talked about. However, the Saudi central bank did buy 932,000 shares of the SLV ETF not long ago, which is an interesting move. I'd like to know what you think about this and whether you think this could be the start of a trend where more central banks try to get silver. That's something we might be able to see because silver is the secondary monetary metal. I'm pretty sure that Saudi Arabia would be seen as an administrator, which means that they could take possession of the base silver. You and I couldn't do that. Yeah, I think that's a trick to make that happen because it can happen even less obviously than what we just talked about. The news says that Saudi Arabia bought silver, but what they really did was buy SLV shares, which are like paper silver bars. The most important detail is that administrators like sovereign bodies can demand delivery instead of individual owners. That changes SLV from a tool for tracking to a way to get things without being seen. In 2023, central banks bought more gold than ever before, so it might make sense for them to start buying silver as well. The public owns paper, but sovereigns can take physical through ETFs. This makes the system two-tiered. Outsiders own promises while insiders own goods. For buyers, the risk is thinking that the two are equal. Next, the speaker talks about how this plan could strategically give elites power over silver. Also, silver is used in every part of the world economy, from solar panels to health and many other things. Gold is also used in all of these areas, but silver is more widely used. Also, I think this could be a plan to make sure they get their hands on the real silver. The people who own SLV won't do it in the end. Well, most of them wouldn't, but JP Morgan and Saudi Arabia would. I believe it is a sneaky way to do it and keep control of it. The real trouble is that it would need to be planned out. They would have to. I'd be interested to know what share of their current silver holdings that would actually be. Because if they took out the physical at the same time that the SLV trust is selling off pieces of silver every day to pay the rest of the fees, it would have terrible effects on the public. With an SLV, they think they really own silver. Do not. They don't have any shares in a trust. SLV isn't a place to store silver. The trust is using ounces to pay for costs while insiders like JP Morgan can say they've delivered. Silver isn't just used to make money. It's used in medical products, 5G, solar panels, and EV batteries, which means that demand in industry keeps going up. People who hold SLV think they own silver, but what they really have is a claim that is losing value. Since the trust sells ounces every day, the real money move goes to people who have the right to receive it. Retail buyers become the way out of the market if sovereigns or banks quietly sell off their physical holdings. It's the best kind of quiet confiscation. We'll now look at how even countries now consider silver to be a key strategic mineral. But that might have a really big effect on how the risk is shared with the people. You make a good point. Platinum was recently added to the list of critical minerals in the United States by the Department of the Interior. Silver was also recently added. Could you tell me what you think about that? Do you think it will have a big effect on the silver market? As long as there are copies, right? So silver contracts are a way for them to make as much silver as possible
Adding silver to the U.S. critical minerals list without much of a fuss sends a message of scarcity risk that goes far beyond ETF charts. With this title, silver joins lithium and rare earths as metals that are known to be important for national security, but the futures market still lets almost endless paper claims go through, which makes it look like there is plenty. David Morgan has said that this structure of derivatives stops real price discovery while the government keeps important resources for itself. The contradiction is clear to small buyers. Official policy sees silver as very important, but Wall Street sees it as something that can be made over and over again. That mismatch will end soon. Next, the guest talks about how past ratios could support silver multiples that the market doesn't care about. But then again, remember that we're almost done, and I do think what went on in 1980 when that $50 mark was reached, I think this is a huge double cup because it did break through that level. This means that if the price of silver goes above $50, would 3 or even 4 digits, which is what we see now, be crazy? No, an ounce of it is worth at least $1,300, and that's just based on the 20th to the one that we were historically, okay? These were both, well, a piece dollar. There is a gold $1 piece and a silver dollar here. That's a 20-to-1 spread right there. Therefore, based on my estimates, this is the real value of an ounce of gold at around $33,000 an ounce. So at $3,400, spot gold is a ridiculous bargain. But that also then means that silver's fundamental value at this moment is somewhere between $1,000. And remember, the more of this that they do, the higher those numbers go, because this is fiat money, government debt-based money. Using the classic 20-to-1 gold-silver ratio, silver's fair value could land between $1,200 an ounce, numbers that dwarf current prices. Historically, that ratio held through the 19th and early 20th centuries, but since 1971, it has ballooned above 80-to-1. If gold were re-rated to $40,000, as some analysts suggest, silver would mechanically re-rate into 4 digits. Of course, markets rarely snap cleanly back to history, but ignoring centuries of monetary precedent is equally short-sighted. For long-term investors, this highlights why silver remains one of the most asymmetric trades available. Up next, the speaker shifts from ratio math to why gold and silver function as bridges between broken monetary systems. But gold and silver are sound money. Sound money is money that can't be inflated away by the government or central bank. They can manipulate what you see through the use of garbage derivatives, but they cannot inflate it away. The point is they are both money. They're just the opposite sides of that money coin. And as this loses more and more and more of its purchasing power value, these go up in nominal terms, but what they really do is they create a bridge, because when one currency goes away, another one comes in. It's just that you need something and I need something. We need something that will hold its purchasing power intact to get us from one system into the next system, and dare I say it, even have the ability to take advantage of the opportunities that will present as these extremely severely overvalued fiat money assets. And real estate is actually not pure fiat money because it is a tangible as well, but it's severely overvalued. That's going to flip-flop. So if you can hold your purchasing power intact, you're going to be able to have that wealth transfer your way. Sound money has historically bridged collapsing currencies from the German mark in 1923 to Argentina's peso crises. As fiat weakens, metals don't get richer. They preserve purchasing power while paper assets deflate. Real estate, despite being tangible, has already detached from fundamentals via debt-driven speculation, leaving it vulnerable in a reset. Investors holding even modest physical allocations are effectively buying insurance against systemic wealth transfer. The bridge analogy is key. Metals aren't about quick gains, but safe passage through monetary storms. Next, the conversation pivots to whether the Fed might revalue gold outright to restore confidence. Want to talk about the issue of gold revaluation? Because this is something that's kind of re-entered the consciousness of talkers recently due to the fact that the Fed released a paper examining gold revaluation in other countries and its impact. This has led a lot of people to speculate that the Fed is considering a similar move, currently valuing their gold at 42 2022s on the balance sheet. I've heard so many different opinions on this. Some people say it'll never happen. Some people say it has to happen. Some people are more in the middle. I wonder what your thoughts are. Is this a realistic proposition to revalue U.S. gold reserves? What would it actually accomplish for the U.S. government, and what could its wider implications be on the gold market? Well, I personally do not see it. I see it as inevitable because what gold really does is it regains confidence. They want us to think that gold is an old relic, except wedding rings are generally in gold. No good is gold. It's in our vernacular, it's in our DNA, and it's used to regain public confidence. At $3,500, the Fed still books it at $42 an ounce, a fiction frozen since 1973. A recent Fed paper quietly revisiting revaluation sparked speculation for good reason. Boosting the balance sheet value of reserves could instantly offset ballooning debt. Other nations like Italy in the 1990s used similar revaluations to shore up fiscal credibility. Skeptics dismiss it as outdated, yet gold remains embedded in cultural and institutional trust. If confidence collapses, few tools restore it faster than repricing official reserves. For investors, the debate isn't if, but when. Washington exploits that lever. Next comes the scenario of how such a reset could unfold right into hyperinflation territory. After that massive failure, which I believe we are like this close to experiencing in the hyperinflation, but make no mistake, every single country has a gold revaluation account. They're not going to do it at these levels because it does not reflect all the paper money that's been issued. So what I think we will see, and it's just a repetition of history because this has happened over 4,800 times. I don't think this time is any different, and that's really what the point is. But they have to, you have to kind of back up to move forward. If they did it now at the artificial level that the spot markets are, then it wouldn't have as great an impact if they wait until they finish blowing up the currency in about a massive hyperinflation. And what they do then is, of course, they lop off zeros so people think, well, they've got this under control, so you've got a loaf of bread. And I know this sounds outrageous, but it's not outrageous. It is just a repetition of history where a loaf of bread might go for, as it enters hyperinflation, a loaf of bread might go for $80,000 a loaf. Right, hyperinflation isn't theoretical. Over 4,800 historical episodes confirm currencies collapse in similar patterns. Governments delay revaluing gold until fiat systems fully break, ensuring maximum impact when trust evaporates. That's why official gold revaluation accounts exist globally. They're tools of last resort, not routine adjustments. The mechanics often look absurd, a loaf of bread costing tens of thousands before zeros vanish overnight. But those optics are designed to reset psychology as much as balance sheets. For investors, the signal is clear. Waiting until hyperinflation is visible means it's already too late to reposition. And what follows is even more sobering: how savings and assets get wiped in the revaluation aftermath. But then what happens? They lop off 3 zeros or 4 zeros as they do that overnight revaluation. And so it goes from $80,000 a loaf to $8 a loaf, but so do your savings, and so to anything that you've accumulated in fiat. And frankly, so will the nominal price of gold. First, it'll go up massively, right? In the hyperinflation. But the difference between, say, your stocks and everything else, that drops dramatically immediately upon the revaluation. Whereas gold, it's on average, so I can't guarantee this, but on average will stay up at that level for about 9 months before it too gets revalued. But then it instantly begins to climb again in terms of that new currency. So that is what I anticipate seeing. I don't anticipate seeing it before we do hyperinflation, because there is not yet the need to regain that public confidence. But I watch that like a hawk, because that, my friend, is the only thing that's keeping all of this stuff together. Overnight currency resets erase savings faster than investors realize. Zeros disappear, but so does accumulated fiat wealth. Stocks, bonds, and cash are repriced downward immediately, while gold holds its surge for months before adjusting. This lag effect has repeated across past inflations, from Brazil in the 1990s to Zimbabwe in the 2000s. For households means gold isn't just protection, it's liquidity in the eye of a storm, bridging into the next system. The real risk is complacency. Waiting for official announcements means you're already trapped in the revaluation cycle. Watching gold closely is not paranoia, it's prudence.